Hello good people and welcome back. So in this video what we're going to do is get started with our seminary in derivatives, and again we're using the fundamentals of futures and option markets by John Hall. That is the textbook that we're using. So what is a derivative? It is an instrument, a financial instrument, whose value depends on the value of a more basic underlying asset. And so what we are saying here is that a derivative, let's call that a financial instrument, A, has a value. So the value of A is a function of the value of something else. Let's call that something else B. That something else is another asset, and that is B. So the derivative instrument is an instrument, a financial instrument, whose value is a function of the value of a more basic underlying asset. What could this underlying asset be? It could be stocks, it could be bonds, it could be currencies, it could be commodities, it could be whatever you can think of. I'm sure a derivative contract can be written on. I know there are derivative contracts on weather and electricity, for example. So you find a derivative contract written on some of those assets. Now they play an important role in transferring of risk in the economy. We'll see how it is that they are structured in order to mitigate risk, essentially, and that is one of the primary roles that derivatives contracts play in financial markets. Now the risk that is referred to here, it is essentially the uncertainty that's associated with that underlying variable, right? What is the uncertainty that's associated with that underlying variable? Changes in interest rate, for example. That's why we can have interest rate risk, derivative contract. Changes in the price of the underlying, the price of gold, price of oil, and we have derivative contracts on those commodities all the time. So what are those contracts that we're going to be looking at? We're going to talk about futures contracts, forward contracts, swaps, and options. Now there are many more of these contracts out there, but for our purpose, we're going to be spending a lot more time just working on these four financial instruments. Those are the focus of this course. Now derivatives contracts are used in a variety of ways. One of the primary goals of derivative contracts or derivative instrument is usually to transfer risk, and if you think of it as hedging risk, the idea here is that there's some level of uncertainty with respect to an underlying asset or an underlying variable, and so you engage in derivative contract to protect your position against movement in that underlying asset. Now, when you're using derivative as a hedge, you typically need the underlying, right? You need the underlying. That is, you want to acquire the underlying at some point in time, or you are trying to make sure that your purchase price for the underlying is locked in early. Another way derivatives contract can be used is for speculation, and speculators essentially do not need, and that's another distinction here, they have no need for the underlying, right? No need for the underlying. All they want to do is simply take advantage of changes in market value. They're betting, they're gambling against the movement of the underlying. And so there's no interest in the underlying itself. All they want to do is to make money. We also have arbitrageurs, and arbitrageurs try to lock in an arbitrage profit. What is unique about arbitrageurs is the fact that these arbitrageurs' goal is to make profit, but not just profit, it is to make risk-free profit. So we're going to think of here, I'm going to say risk-free profit. And so arbitrageurs seek opportunities, they seek circumstances where there is a degree of mispricing between the underlying and the derivatives contract, the value of the derivatives contract, for example. And so that's what they are focusing on. They're trying to figure out where are those mispricing, and then they engage in those transactions for the purpose of locking in those sure profits. And that's how arbitrageurs are different from speculators. Speculators can take risk, and they don't care quite about the level of risk, so long as they have a return that compensates them for risk. Arbitrageurs, on the other hand, do care, and all they want is risk-free profit. Next, what we're going to do is talk about the uses of derivatives contract that are associated with the change in nature of a liability. Well, the change in the nature of a liability refers to a scenario where you have a payment that is recurring, and that payment is variable and it changes over a period of time, and you don't want to have that degree of uncertainty because you never quite know how much you will have to pay. And so in exchange for this variable payment, you can acquire a fixed payment that would remove that uncertainty for you. And that is what we're going to see when we talk about swaps. So what we have here, if I could draw that for you, it would be something like this, where you have a series of payments that you're making over a period of time. So those are payments that you make, and they're all different. So then payment 1, payment 2, payment 3, payment 4, payment 5, and payment 6. And all of these payments are different from each other. I could do this by simply saying they're different, they're different, they're different, they're different, and they're different. Now, today you don't quite know what these payments are, right? You have no idea what these payments are going to be. You know that you have to make those payments. You just don't know how they're going to change. Why would you not know? You may not know simply because this payment might be linked to a macroeconomic variable, say interest rates. And interest is changing, which means payments are changing. You cannot forecast interest rate quite accurately, and so you cannot forecast your payment quite accurately. So what you want to do is you want to exchange this changing payment for a fixed payment, this P0, 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 P0 here, and where all the fixed payments are equal to each other. And this exchange of cash flows, a fixed cash flows, receiving a fixed cash flows for a variable cash flow, is what is referred to as changing the nature of a liability here, and that is what swaps contracts do for you. And we'll talk about that some more a little later. We can also use derivatives contract to change the nature of an investment without incurring the cost of selling one's portfolio and buying another one. The idea here is that you say you own a portfolio of securities, and this is your portfolio, and that's your portfolio P of securities. You like what makes up this portfolio, and but you understand that market conditions are going to change, and so as market conditions changes, the value of your portfolio is likely to change as well. And what you want to do is you want to protect your portfolio against negative changes in the market conditions. And so what you do is, instead of having to totally rebalance your portfolio where you have to sell and buy some other assets to adjust your portfolio for anticipated market conditions, and in the process incurring transaction cost, instead of having to do that, you could simply engage in derivatives market that would protect your positions. You could use options, for example, put option, in order to protect your position. And we'll talk about it later how it is that put options are also seen as simply insurance, or option contracts are typically seen as insurance. Now, with the first type of contract, we said earlier that we're going to talk about these four, so futures, forward, swaps, and option. We're going to start with futures contract. A future contract is an agreement to buy or sell an asset at a certain time in the future for a certain price. So what are we saying here? What we're saying here is, if we have a timeline here, today we sign a contract. On that contract we say we are going to buy or sell something, which is the asset, at some point in the future, which is this maturity time here, for a certain price, which is the price of the asset, or the expected future price of the asset. And so that is a futures contract, locking an agreement for an exchange that's going to occur sometime in the future. There is no exchange happening today. All that happens today is the signing of this agreement conceptually, right? It doesn't quite happen like that, but conceptually that's what it is. We sign a contract that says sometime in the future we're going to make that exchange, and that's how it's going to happen. I'm going to buy, or you're going to sell at a given price at a given time in the future. Typically the quality of what is also going to be exchanged is mentioned there as well. By contrast, in the spot market or spot contract, there is an agreement to buy or sell an asset immediately. So the futures market is different. The futures market is different from the spot market in that futures market refers to transactions that are happening in the future, whereas spot market refers to transactions that are happening immediately or within a very short period of time. So whenever we refer to the spot market, we're thinking right away. Whenever we think futures market and forward market for that matter, we're thinking a transaction that's going to happen sometime in the future. Now, these futures contracts are binding agreements. It's a contract, right? You cannot walk away from the transaction. If you walk away from the transaction, that creates credit risk, default risk, and we'll talk about all of that a little later. But these are binding agreements, and therefore the transaction has to occur. It is not an option for the transaction to occur. It is a binding agreement. Now, these contracts are traded on exchanges, futures contracts in particular, and we'll talk some more in details about futures contract later. But for now, they've been trading for ages, for quite some time, and they are traded in variety of exchanges. And we have the CME group, which is the Chicago Mercantile group, exchange group. And then we have the Intercontinental Exchange, and so on and so forth. So those are just venues where these contracts are exchanged. These contracts are entered into. They've been trading. They've been in existence for a long time. And these have been, I think, they started with farmers that wanted to guarantee that they were going to sell their harvest, right? So you had, for example, a farmer here. This is our farmer, and our farmer is planning a harvest of corn at some point in the future. And the farmer is worried about the price of corn over this period of time after the harvest. And so the farmer wants to guarantee that she will sell the corn over a period of time post-harvest for a good price. And so in order to lock in the price of corn today, she may enter in a futures contract that specifies how much corn is going to be bought, what is the price per ounce of corn or per barrel of corn, or however you want to measure the unit. And it's also going to be specified when it is that the corn is going to be exchanged, sometime in the future, of course, post-harvest. And it's also going to specify the grade of corn, like what is the quality of corn that's going to be exchanged. That is one of the reasons these derivative instruments were so interesting, and they got so popular. Futures prices are the price for a particular contract, or the futures price for a particular contract, I should say. futures prices for a particular contract is the price at which you agree to buy or sell at a future time. So when you enter as a farmer, you enter into that transaction, you are locking in a price today for a transaction that's going to happen in the future. That price that you're locking in today is our futures price. And how do we estimate that price? Well, we find that price using simply the demand and supply as for the spot market. Remember, the spot market is for transactions that occur immediately, so demand and supply of this decision happens right away. In the futures market, similar process is observed. We're going to see that in detail a little later. For now, what we want to understand, or we want to have, is big picture. What is the futures price? It is that price that we will pay later for that underlying that we are guaranteeing, for which we guarantee the sale of the purchase today. Now, it used to be that the exchanges where all the trading of these derivatives contract was done in a system that is referred to as the open outcry system. The open outcry system is a scenario where you had a physical location and traders get in there and make the negotiation with each other. Now that has since changed quite a bit. Today, most transactions are done electronically. We still have a little bit of transactions that are done physically between traders of these contracts, but most of it happens electronically, where the trader offers a price and bids on a contract, and it is up to an electronic system and an algorithmic system to match the demand and supply. And so that's how a seller is able to make the sale, that's how a buyer is able to make the buy, and it's all based on this electronic system, an algorithmic system. And that's made transaction a lot smoother, transaction costs a little cheaper over a period of time. Alright, so now let's look at a quick example of a futures contract. So for this futures contract, what we have is an agreement to buy. So we're buying 100 ounces of gold. And so the buy here is the gold, right? We want to buy. And we want to buy 100 ounces, which is our quantity of gold, which is our underlying, at the given price. And that price is going to be $1,100 per ounce. And we're going to be making that purchase sometime in the future, which is December. So in this case, what we have is the 1,100 that we have here is our futures price. The gold is our underlying asset. 100 ounce is our quantity we are going to buy, and we're going to buy that sometime in December. Now, in the second example that we have here, we are selling 62,500 pounds at $1.50 per pound in March. All right, think about this for a second. We are selling 62,500 pounds. So the underlying here is a currency, and that is the British pound. And we're selling this much British pound, that's our quantity, at the price per British pound, which is the exchange rate. And that price per British pound is $1.55 per US dollar per British pound. And when is the transaction occurring? It is occurring in March. So in the first example, we had a commodity as the underlying. In the second example, we had the currency as an underlying. In the first example, we were buying. In the second example, we are selling. Now, third example here, what we have is we are selling 1,000 barrels of oil at $40 per barrel in April, similar to what we had earlier, right? In this case, what do we have? We're selling 1,000 barrels. That's going to be the quantity. Oil is going to be our underlying, and we're selling that for $40 per barrel. That is going to be our futures price, and we're selling that at some point in the future. That's going to be April. Okay, and a little more terminology here for us. The party that buys, that agrees to buy, is taking a long position in the underlying, and that is the party that agrees to take delivery. So if you take delivery of the underlying, you are essentially referred to as the long party. That is, you're paying for the underlying. The party that agrees to sell has a short position. If you make delivery of the underlying, that means you're selling the underlying. You're referred to as taking a short position. So long position, buying the underlying, taking delivery of the underlying. Short position, making delivery of the underlying, selling the underlying. Another quick example here to see how this would work. Say in January, an investor enters in a long futures contract to buy 100 ounces of gold at $1,100 per ounce in April. So let's go back to our board here and let's make the transaction. So we are in January, and in January what happens is we have February, March, and April, and we really don't need what comes after that, so we're gonna stop here. So January, February, March, and April. In January we enter into a transaction, and what is that transaction? That transaction is the purchase of 100 ounce of gold for $1,100 per ounce. So we go back here, we're saying we want to buy 100 ounce of gold at the price of $1,100 per ounce, and we signed that contract today. We said we will do that in April. So that's our futures contract. Now comes April, and this is April, it's February, March, and then April. Comes April, it turns out that the actual price is $1,175. That is our actual price in April. So in April, the actual price is $1,175 per ounce. Now, how much are we paying for the gold? Well, we said we would do this at $1,100 per ounce. So that's what we're paying. So comes April, the seller, that's our seller who had the short position, is going to be receiving $1,100 per ounce for 100 ounces. That is, he's going to be receiving from the buyer, and the buyer is also the long party. Now, what is the buyer receiving? The buyer receiving 100 ounce of gold. So overall, how much did the buyer pay? Well, the buyer pays $1,100 per ounce, right? Multiplied by 100. So the buyer pays $110,000 and receives 100 ounces of gold. So I'm going to use that to receive 100 ounces of gold. So you pay that and you receive this. The seller, on the other hand, receives 110,000 US dollars and gives up the 100 ounces of gold. Now, what could the buyer do with this gold? Well, the buyer could turn around and sell it for 8,175 because that's the price at which it's trading in the market now. And so if the buyer, if the long sells at 1,175, what is the profit? Well, the seller is going to sell at 8,175 multiplied by 100, so it's going to sell at 817,500, and the seller bought for 110,000, which means that the seller made a profit of $7,500 in this transaction. Now, the buyer, I should say, the buyer made a profit of $7,500, not the seller, because we're working with the buyer here. The seller, on the other hand, could have sold the gold for 8,175, but because of the futures contract that the seller got into early in January, the seller could not sell it in market for 8,175. The seller had to sell it at the futures price, which was $1,100 per ounce of gold. And so the seller is going to lose. So the loss here for the seller is going to be the same as the gain for the buyer, which is 7,500 US dollar. And that is what an example of this, how one of these would essentially work. Typically, the transaction are not these very few times where the buyer actually takes delivery of the underlying. Typically, there's a process that's referred to as netting, especially in the futures market. But we'll talk about that a little later. But this is a good example of how a futures contract would work. Now, ultimately, what you should take from this is this idea that the transaction might be beneficial for one party and not for the other one. But the goal is not necessarily to make a huge profit. The goal for the seller perhaps was to guarantee that the sale was going to happen, right? So the goal for the seller was not to make the extra 7,500 because perhaps the seller had already covered the cost of producing or getting gold at $8,100 and with some margin. So the seller was happy with the $1,100. Could have made more, but that's not the problem because they reduced the risk of not even selling at all, right? Because the price of gold could well have gotten all the way back to $800 per ounce. And so if the price of gold were to fall to $800 per ounce, the seller would have made a profit, and the profit for the seller would essentially have been what? The profit for the seller would have been the 1,100 minus the 800, which is the 300 difference that the seller would have made on the transaction per ounce times, of course, 100 ounces, and the buyer would have lost about the same amount, right? And so ultimately, the goal is to remember what is the objective when you get into this kind of agreement. If your objective is selling, is guaranteeing a sale where your costs are covered, then the seller is fine. And the goal of the buyer is also to guarantee that she is going to receive the gold at that point in the future. Then the buyer is also fine. And so the buyer may not just go out and sell the gold if the buyer actually needs the gold, right? So let's say the buyer makes jewelry, watches, chains, necklaces, bracelets, things like that. The buyer would need the gold. So the buyer would not necessarily make this profit. The buyer would just be happy to have acquired the gold cheaper than what she would have paid in the market for it. And that's the idea here. Alright, so let's go back to our slides and continue. So in this case, who made the profit? The buyer, the long party, made a profit, and the short party made a loss. And the amount of the profit was $7,500, and that was $7,500. That's our profit, which is the same for the loss. The loss was $7,500. Now, the over-the-counter market is an alternative to the exchange market, right? So the over-the-counter market is an important alternative to the exchange market, and trades are usually done on the over-the-counter by financial institutions, large corporate treasurers, and fund managers. What do over-the-counter market offer that exchanges do not offer? Well, over-the-counter market have this feature that is unique to them, that is the customization of contracts. Futures contracts are very typically highly standard, and this is why they trade on an exchange, right? They're standardized in terms of quantity, size, quality, size, delivery date, and things like that. So futures contract that trade on over-the-counter futures contract that trades on exchanges have that limitation. On the over-the-counter market, that limitation is removed, and when that limitation is removed, it provides this financial institution with a lot more flexibility, where they can have a variety of delivery date, not just the ones that are set by the exchange. They can have a variety of sizes, they can have a variety of quality of the underlying, and so the customization feature of futures over-the-counter market is very attractive for these financial institutions. Transactions on the over-the-counter market have grown significantly over time, and they are much larger than the transactions that happen on exchanges. So the over-the-counter transactions are much larger than what we observe in exchanges, and that's what this picture here shows us. It shows us that over-the-counter transactions have significantly increased over time, whereas exchanges transactions have been fairly constant. Now, there's a little distinction here, in that these over-the-counter transactions are recorded as a principal amount, notional amount. So principal amount, whereas these transactions are value based, right? So if you think of this as this would be the face value, for example, for a bond, and this will be recorded as the price of the bond. So the face value of the bond is that $1,000 that's not going to change, whereas the price is going to change with respect to the maturity of the bond, right? So in interest rates and stuff like that. Yeah, so that is the distinction here. But generally, the OTC market is a lot more attractive than the exchange, and it is primarily because of customization. It used to also be because of the lack of regulation in the OTC market. The OTC market was not as regulated as the exchange market, and so investors would take advantage of this absence of regulation in the OTC market, and that was another attractiveness of the OTC market. Now, that's not true anymore, because a series of regulations have occurred, especially since the 2008 financial crisis. There's a series of new regulation, and among those regulations is this idea that most standard OTC products, so the OTC product that are standard in some form, are traded between that are traded between financial institutions must be traded on what's referred to as a swap execution facility. So we have to have a little more visibility into what those transactions essentially are. Also, a central counterparty or central clearing party must be used as an intermediary for standard product when they are traded between the financial institution. So it used to be that Bank A would reach out directly to Bank B and enter into an agreement and exchange with each other, and they would enter into an agreement directly. Now what we're saying is that we have to have a central clearing party to serve as a middleman. So the central clearing party is going to serve as a middleman, just like the exchange plays that role in the exchange market. The central clearing party plays the same role as the middleman in the OTC market. So the regulations are changing, and the OTC market is becoming a lot more like the exchange, and that's what we have here. The OTC market is becoming more like exchange traded market, and that is because of the abuses that were observed during the 2008 financial crisis on the OTC market. All trades must also be reported in a central registry. We should have a lot more visibility into those transactions. Without the middleman, there's very little that we know about those transactions, so we have less clarity about the risk that these companies are taking. And so if we don't know what those risks are, we are as investors are not well informed in our approach to investing into those organizations. Now, one of the type of risk that these direct transaction led to is what's referred to as systemic risk. And the idea with systemic risk is that because of the volume of transaction between financial institutions, having one financial institution default, so a default by one financial institution is going to lead or can lead to losses by other financial institutions. And so if we had a picture of it, it would look something like this. We have a financial institution A here that does business with a series of other financial institutions. So it does business with these other institutions here, and those business go like this, right? They're all doing business with each other. Now, that's not all, because all these are also doing business with each other, and also they are doing business with other parties, and so on and so forth. Now, if this institution defaults, if this institution goes away, what's going to happen? All of the other transactions are going to go away, and therefore this might default, that might default, this might default, that other company might default. So this is what's referred to as systemic risk. The idea that a default by one might cause a series of default that could get the financial market in trouble. Okay. Next, we're going to touch on forward contract. So, what is a forward contract? A forward contract is very similar to a futures contract. So they're very similar to futures contract, except that they trade in the over-the-counter market. And so because they trade in the over-the-counter market, remember we said over-the-counter has this feature that says that allows for customization of contracts. Because they trade on the over-the-counter market, these forward contracts are very much customizable. And so because of the fact that they're customizable, they're very popular. And among the forward contracts that are traded, remember they can be traded on literally anything. But among the ones that are popular, we have currency forwards and interest rate forward. And we'll talk about those a little later when we touch on forward contracts. Now, similar to the futures, the forward price is the delivery price. So the forward price for the contract is the delivery price that would be applicable to the contract if as if the contract were negotiated today, right? So we are negotiating for a transaction that's going to happen in the future, and we lock in the price today. That's essentially what that is. And the price that we agreed to today is the delivery price is the forward price. So it is the delivery price that would make the contract worth nothing today. And so if you think about it, the transaction is going to happen at some point in the future, and we are making an agreement today. What does that mean? It means that for no arbitrage to exist, the price that we agree to pay today should be equal to the future value of the underlying, right? So it's like we're making a forecast of what that value of the underlying is going to be, and therefore we are using that future value today to lock in the agreement, and therefore we're eliminating the possibility of an arbitrage to exist there. The forward price may be the forward price may be different for contracts of different maturities, and that simply makes sense, right? The farther out the maturity, the farther out the time for the exchange, the more likely it is that the value of the underlying is going to change, and the more likely it is that the future price or the forward price in this context is going to change. And so different maturities, different prices. Now this is an example of quotes for different maturity contract, and this is for exchange, foreign exchange. So what we're working is US dollars and Great British Pound, and these are back in 2015 the values. So on the spot market, remember the spot market, what we have is immediate transaction, right? So for immediate transaction, a market maker is willing to pay $1.54 per British pound, and he is willing to accept $1.57 and 57.50 $1.5750 dollars for 1 British pound. And so when you think of the bid, you think of what the market maker is willing to pay. You think of the offer, you think of what the market maker is willing to accept as payment. So the market maker is willing to pay 1.5746 for 1 British pound immediately, or in within a very short period of time. And the market maker is also willing to sell 1 British pound for 1.5750 US dollars immediately. Now, 1 month from now, which is the 1 month forward, the market maker is willing to guarantee today that the transaction is going to happen 1 month from now at $1.5742. That is, the market maker is willing to pay in 1 month $1.5742 for a British pound. In the same manner, the market maker is willing to accept 1.5747 US dollar for a British pound in 1 month from today. The same approach to understanding this goes for the 3 months and the 6 months. So 6 months from today, the market maker is willing to pay 1.5730 US dollar for a British pound, and the market maker is willing to accept 1.5736 US dollar for a British pound, or the market maker is willing to sell a British pound for 1.5736 US dollar. And now what you see is that as the maturity changes, we go from the spot to 1 month to 3 months to 6 months. The bid and the offers all change as well, right? And that's what we had earlier here when we said that the forward price may be different for contracts of different maturity. Here we have different maturity in this 3, 6, and 1 month forward, and we have different bid and offer prices. Okay, so what we're going to do next is work an example, and this is the example that we're going to be touching on. Let's say we are in May, and the treasurer of a corporation wants to take a loan forward position to sell 100 million pounds in 6 months at an exchange rate of a 1.5736 US dollar per pound. What does that mean for us? Well, it means that this corporate treasurer, what he wants is he wants a dollar 1.5736 US dollar for every British pound that he has, and he has 100 million British pounds. And so if he gets into this transaction, he's going to give away the 100 million British pound and receive 1.5736 US dollar for each British pound he has, which means that he is expected to receive 157.36 million US dollars and give away the 100 million British pounds. And so, that transaction is going to occur sometime in December. Now, what are the possible outcomes of this transaction? Let's look at it on our board here. So we are in May, and 6 months from May is going to be December. So we're going to do that. I'm going to say that is December. And we don't know what's going to happen to the exchange rate. And we just said that what we wanted to occur is we have 100 million British pounds. So that's 100 million British pound that we want to get rid of. We want to sell that, and we want to sell that for 1.5736 US dollar per British pound that we're giving up. And so that contract guarantees that a transaction is going to occur, right? So we're taking up that position. And so in December, what's going to happen is, let's say we have the corporate treasurer here and getting the transaction with another treasurer in the UK. So that's the US treasurer and that's the UK treasurer. The US treasurer needs the US dollars. And so he gets into that transaction, and what's going to happen is he is going to receive 100 British pound that he has, multiply that by for each one of those British pound, he's going to get 1.5736 US dollars, so 1.5736, which means that he is going to get essentially a 157.36 million US dollars. That's what that trader is, that corporate treasurer is going to get. And he's going to get that in December because of the contract that he signed in May. Now, in exchange for that, what he's going to do is he's simply going to pay the 100 British pound that he had. And so the treasurer in the UK, she's going to receive the 100 British pound, and the US treasurer is going to receive the 157.36 million US dollars. Again, remember this 100 British pound here is in million, 100 millions. Now, what else could happen in December? We locked in this transaction, so we know that's what we're going to get. But the question was really, what are the possible outcomes, right? Well, the possible outcomes are, you can have a variety of possible outcomes. First, we may have a scenario where the price, the exchange rate is far much higher. I already said the exchange rate is at 1.7, and if the exchange rate is at 1.7, the treasurer in the US could have gotten 170 million essentially for the 100 million British pound that he had. And so by getting into this transaction, if this transaction is locked in as such, the trader is essentially losing the difference between 170 million minus 157.36 million. And that calculator, let's pull our calculator here. That calculator says 170 minus the 157.36 equal 12.64 million. So the trader would essentially lost 12.64 million. Now, the loss here is only relevant if the trader was speculator, right? If the trader or the corporate treasurer here only cared about locking in the rate and wanted to reduce the risk of a change in interest or in exchange rates over this period, that corporate treasurer has no problem getting into this transaction. He's fine. And so is the treasurer in the UK if she was getting into this transaction for the purpose of eliminating risk. Now, it could also be that the interest rate is much lower. And so let's say the exchange rate is much lower. Let's say the exchange is at 1.2. So if the exchange rate is at 1.2, the corporate treasurer in the US would have gotten 120 million, and instead he got 157 million.36. So in this case, this treasurer would have made the difference, which is about 37 million. And so you can see here that exchange rates are likely to change over this period. It might be that exchange rate at this time in December is exactly what we locked in into the contract, which is 1.5736, in which case both parties say, well, we netted a zero there. Or it might simply be that the exchange rate has changed and is not 1.7, in which case one of the parties is going to feel like, well, I kind of left some money on the table here, and that would be the long party here. But at the end of the day, the goal is to remember what the goal is. Typically, the goal is for eliminating risk. The goal is not for speculation. So you're not getting into this transaction always to make a profit, or you're getting into this transaction most of the time to reduce the likelihood of a huge loss. And so interest rate could have been a lot worse than that. Okay, so that wraps it up for our scenario here, where we talk about we introduced the concept. We talked about futures and forward. We talked about the markets. And in the next video, what we're going to do is we're going to talk about options, and we're going to wrap up our discussion with the approaches to hedging with the derivatives contract, just an introductory discussion. I will see you in the next video for that discussion.